Okay, so Taylor's married, he's happily married. Now he wants to sell some stocks. He says he wants to sell some stocks that he bought back when he was in college, and the stock has grown significantly, and he needs to sell some to buy a house. Okay, so now we have to help Taylor figure out about his stock situation that he has. Okay, so let's go through the general understanding of taxes. So we need to explain to Taylor how to calculate capital gains, what capital gains really means, and all the different tax treatment for it. So understanding gains or loss, that's the first part, is what is the overall gain that or loss that he has with the stocks, right? So he bought something, he sold it for something higher, that delta in between is the gain. So that's easy to understand right there. And the next thing is capital gains tax rate. This really depends on how long he held that stock for. So if he bought it on January 1st and then he sells it the following year after the next January 1st, so more than a year, then it qualifies for long-term capital gain. The way I explain it is like you're climbing up a ladder. Once you reach the 1 year mark, then it qualifies for long-term capital gains. But if you don't reach the 1 year mark, it's going to be considered short-term capital gains. And each one is treated differently because long-term capital gains has a preferential tax treatment where you pay lower taxes just for having something called long-term capital gains. So if you sell the same stock under a year of holding it, you're going to pay whatever your income bracket is. But if you wait till a year, then you can either pay 0, 15, or 20%, which is potentially a lot lower than your actual tax bracket itself. So a big financial strategy is figuring out how do we get to long-term capital gains, because we want to make sure that clients are trying to sell when it's long-term capital gains whenever possible. Okay, so how do we determine long-term capital gains rate? Let's just say Taylor is married filing joint, right? And you remember his income was like $100,000, right? His income was $100,000, and let's just say he contributes to his 401k. Let's see, he maxes it out. Oh, that's what I was gonna draw. Okay. So Taylor's income is $100,000, and then let's say he minus $20,000 for 401k, and then he minus $5,000 for his HSA contribution. So what's the taxable amount that he has? 75,000? Yeah, okay, perfect. 75,000. Okay, so looking at this, assuming the wife is a student, if we look at married filing joint, 75,000 is right here, right? 0%. Meaning between $75,000 and $96,700, this is going to be 0% capital gains. So technically he could sell, what's the difference here? 21,000, right? He could sell up to $21,000 in stock gains and pay 0% on it. That's the benefit of having long-term capital gains. But if he were to sell stocks as short-term, like he sold stocks that he held for less than a year, well, he's going to still pay whatever bracket that he's in for 75,000, right? So that's why we want to make sure that we do tax planning around this to see what range are they in. Most clients are going to be in this range, in 15%, which is way lower because their normal tax bracket for that range is going to range from 20 to 35%. Okay, so big difference in savings when it comes to long-term capital gains. Another thing that a lot of accountants forget to tell clients is that when your total income is at a certain threshold, there's extra taxes you're going to have to pay on capital gains and other things. So the extra tax is called a net investment income tax. And for Taylor's case, he's married, it's going to be $250,000. So fortunately, he doesn't have to face this because he doesn't make over $250,000. But if the wife starts working and then she has high income, now their income is over $250,000, any stocks that they pay, they're going to have to pay an extra 3.8% Medicare tax on top of the regular capital gains tax. Okay? It doesn't matter if it's short-term or long-term, it's always going to be an extra 3.8% Medicare tax. Okay? So let clients know that clients are going to come up to you and say, hey, I heard long-term capital gain is 15%, but then they're in this range where it's over, it's technically almost 19%. Almost 19%, right? So clients need to understand that. Same thing if so there's this one bracket where capital gains is 20% if your income's over, I think that's 600,000. It's actually, at that range, it's going to be 24%, okay? Then you add the state as well, if the state does have income tax. So letting clients know that it's not just 20%, it's actually a lot higher, okay? So avoid surprises by letting them know about these little things first, okay? So one thing we could do is we could do tax planning when it comes to stock sales. So Taylor, he came to us and he says, hey, I have all these stocks I need to sell. What do I need to know about it? So one thing we do is we could sell certain lots to reduce the tax or to pay the least amount of taxes, right? We're not just going to sell random lots and then and just pay whatever tax is available. There's a way to do it. There's a calculation that we could do where to get this, let's say the client wants to take $20,000 out, there's a way to do it where they could pay the least amount of taxes by taking out the $20,000 by selling specific lots, right? Not just random lots that equal out to $20,000, but very specific lots to reduce the taxes. And we'll go over that as well. Okay, when it comes to stock sales, one advice, or these are the 4 advice that we could actually give to clients when it comes to stock sales. And the most common one is, they call it harvesting capital losses. So when you have capital gains, let's say sell a stock and you made money on it. If you're holding on to other stocks that maybe you lost money on it, you could sell those to offset the gain. Okay, it's a very common strategy to use because if you have a lot of different stocks that you're holding on to, there is a chance that you're holding on to some stocks that are losing, and you could always sell that to help offset the gain that you already sold on the other stocks. Okay, the next one's opportunity zones. We're not going to go into the details of it. It's pretty much you sell your stocks at a gain, you take that gain and you reinvest it into something else, and it's called opportunity zone. And then you just defer the taxes on that one. The other one is we want to lower overall taxable income. So in this case right here, if Taylor didn't do the 401k contribution, if he didn't do the HSA deduction, his total taxable income would be $100,000. So meaning that he doesn't get to utilize that 0%. Okay, so figuring out what can we do to lower his income just to get into this range right here, because this is over $20,000 of stock gain he could sell at 0%. So very important. Okay, the other one is you could donate stocks to a charity as well, and donating stocks is usually for really high income people. So it's not very common. I only have like 3 or 4 clients that actually do it. So pretty much donating stocks, all it means is that you could buy the stock for like $10, and then after a year it goes up to $20. When you donate the stock, the value that you get to deduct is the new current fair market value, which is $20, not the $10 you bought it for. Okay, so it's a strategy to to get rid of stocks, but take advantage of the appreciation to get a higher deduction. Okay, so let's talk about this right here. Let's just say Taylor has all these stocks right here. He has Apple, Google, Amazon, and SPY. These are the number of shares he's currently holding. This is the purchase price that he bought for each share. This is the purchase date, and this is today's price. Okay, this is what the value of the stock is worth today. So we know that the client is in the 22% bracket. We know that he's going to pay long-term bracket of 15%, and the client needs $12,000. Okay, so in this case, what is it that we need to figure out for the client to get $12,000 out and pay the least amount of taxes? So looks like everyone is agreeing to sell Google, Amazon, and SPY for Taylor to sell. He needs $12,000. And why didn't anyone recommend Apple? So one strategy, how everyone mentioned that Apple is short-term, right? And has a log gain. But right now, what's today's date? December 11th? December 11th. And he bought this on January 1st of 2024. So if he just waited, 3 weeks, all of a sudden this would become long-term capital gains, right? So definitely letting clients know that there are certain stocks that even though it might look good, like that they want to sell, but if they're about 3 months or under away from long-term capital gains, I tell them don't sell it. Just wait until you hit the 3 months to qualify for long-term capital gains, because now you're moving from 22% to 15%. If you just, in this case, he waited 3 weeks, right? Very important that it's a big tax savings by doing that.